All
Good
right.
morning,
Well,
everyone, wherever you're at. Maybe afternoon. I doubt that, though. But good morning. My name is Adam Linneman. I am the Green Executive. I have Damon Pistulka. Did I pronounce that right, Damon?
yes,
Pistulka.
you did. Thank you.
With us here today from Exit Your Way. Damon is an expert in really helping other businesses look into ways to make their businesses, number one, more saleable, and number two, help them with an exit strategy for retirement. And I don't think many of us think about that oftentimes in advance or give enough notice for that transition to happen. And so Damon's going to talk with us a little bit today about that and how that can become a reality whenever you're ready to make that transition into retirement down the road. So without further ado, I'm going to go ahead and turn this over to Damon. Damon, thank you so much again. And the webinar is all yours.
All right. Thanks for having me, Adam. Thanks, everyone. I'm going to load up I'm going to try this. I've not tried this before, but I don't like doing a presentation where I'm just in the background. So this thing is going to kind of stick me in front. We'll see how it works. So today we're going to talk about exit planning. Obviously, I really don't like it when people just generically talk about exit planning because really what we're talking about today is business exit planning. It's a lot different from other things that people might want to think about. But when you're in a business, you really need to understand what you're going to do with it in the long run. And as Adam says, it's real easy to overlook because you're busy running that business. You're busy in the business. You're busy trying to make money and do the things you're trying to do. But we're all going to exit someday, whether we like it or not. That's the sad reality of it. But knowing how you want to exit and then working towards it might be one of the most important things you can do for your business legacy and for your long-term, reaching your goals. So without further ado, we're going to get started. The first thing we're going to say about exit planning is start early to win. Why we say that? Because in exit planning, everything is months. It's just slow. The work is slow, right? It's like compounding interest kind of slow. It takes some of this stuff is years. And if you have some advanced tax things that you're trying to do to reduce the amount of capital gains you're going to pay or something like that, it may not be applicable to you, but if you know somebody or it is you, by starting 5, 6, 7, 8 years ahead of time with those tax planning exercises, you can save hundreds of thousands of dollars in capital gains taxes. I just want to say that. And the other thing is, when you are doing these kind of things to really execute your exit plan, some of them are long-term things. I mean, if I was wanting to sell my business in 2024, sometime in 2024, I will be working really hard, and I had the value I want and everything else. I'd be working really hard already in 2023 to prepare. But when you talk about your exit plan, there's really 4 options you have when you're going to exit your business. You're going to sell your business, which everybody thinks about. You're going to succeed your business to a family member. That's another way to do it. You're going to run it until you're done and close it down. It's one that people don't think about often, but sometimes that's honestly the best thing to do. And the last one that is rarely spoken about is you might want to or need to run the business until you die at your desk. And I've talked about that a lot over the years, and I want to bring it up today for a little bit because these are all valid strategies, exit strategies, right? It's just what's right for you. So you can sell, you can succeed, you can run it until you're done and then close it down and sell stuff off or sell your customers, what you're going to do. Or you can actually plan to stay in your business as long as you are physically possible and then have all the arrangements set up so when you're no longer physically possible, this is what happens. So we're going to move on and go down this thing. So in exit planning, first of all, I want to spend just a moment on this. How much for what's next is a big question to ask, because if you haven't taken the time to get with a financial planner and realize that and understand how much money you're going to need for retirement or your next phase in life, whatever it is. Because we work with entrepreneurs that are selling a business, going off and maybe selling a business, building another business, doing whatever as well. So you really need to know how much dollars you need for what you're going to do next. And that's a financial planner that's going to take the time to go, okay, Adam, what kind of lifestyle do you lead? Do you want to have a house in Mexico or in a house, near your grandkids? How many days do you want to travel? What kind of travel? What kind of lifestyle do you lead? How much do you eat out? I mean, all these kind of things, because, and then they're going to back that into what kind of portfolio you need to be able to support that lifestyle. This is key in this, because in this, you're going to find how much you need to get from the business, because you're going to have other investments, you're going to have property, you're going to have whatever it is, some stock, whatever the heck it is that you're doing. And this changes all along, because if you're doing, like I'm sure Adam is talking to a lot of you about, is, investing outside the business, diversify risk and things like that as you're running your business. But this is really what we're boiling it down to. How much do I need from the business? How much does it have to give me? And then we think about the next thing right after that is how to get it. There's only two ways you're going to get it out of your business. You're going to get it from your current cash flow, monthly cash flow, and you're going to get it with the terminal value at the end if you sell it. So those are the only two ways to get money out of your business as you go. And in the terminal value could be, I'm selling my equipment, customers, whatever I get out of that over time, or whatever you decide to do there. But you really have two ways to get the money. So understanding, again, like I said, how much you need and how you're going to get it is a couple of the first things you want to start from in exit planning, because if the number's huge, that obviously changes your trajectory. If the number's low, that at what I need for my business, that changes the trajectory. So really knowing this as early as you can, is really important. I mean, we've had people do this in their 40s before, and it is a really good exercise. It's an eye opener for them, because when you get this and understand how much you need, if I did it today, if I did it at 50, if I did it at 60, you're going to be able to really understand what I need for my business and how I'm going to, and then planning on how you're going to get it. So the making your business saleable. So that we're going to talk about the topic of this. And I only want to talk about other stuff because, understanding your number, understanding, how you're going to get it from your business is really key, because making your business saleable gives you that terminal value. And it also is going to, how much your business is able to sell for, also control how much you need to take from current cash flow and invest outside the business, or, and how much I'm going to need from the sale of my business. So the first thing in making your business saleable is really understanding why they don't sell. And there's three main reasons why businesses don't sell. And those are, I'm going to do one thing here quick. I didn't have the chat up. If you have questions, just put them in the chat, or we can just do Q&A at the end. But
yeah, I was just going to say, send in the chat questions. If we can probably spend a few minutes halfway through the presentation, then definitely wrap up towards the end.
Yeah, we'll definitely stop whenever you want. Even hey, I've got a question, and we can stop, and you can type it in, whatever you want to do. But so understanding why businesses don't sell. And now you can search Google for this too, and they're going to say basically the same thing. They talk about owners' value expectations. It's the number one reason why businesses don't sell. And that's basically, you're going to get offers for your business. You're going to say that's not enough money. It's the biggest reason why. And that doesn't matter if it's a business that's doing $1 million in revenue, or business is doing $50 million in revenue. I've seen it happen at both ends, because the next thing is what really can affect it a lot. And that's the business risk. And what we're talking about there is the risk that your business has from the buyer's perspective. So when we'll talk about that more, but there's risk in the business just based on, what you're doing, customers and those kind of things, but we'll talk about that. That's number 2. And number 3, and this is more important as the businesses get smaller, is limited value in the business outside of the owner. This happens when you are the one that makes the trains run on time. You're the one that does the bidding. You're the one that does the accounting. You're the one that handles payroll. You got to really work over time to minimize the business's day-to-day dependency on you. And I'm sure that's something that Adam talks about a lot. And we'll talk about that a little bit more, but so in the beginning, the reason why this is so important to really understand why they don't sell is because only about 25% of the businesses that get put on the market actually get sold. So you got a 75% chance out of the gate that you're not going to sell. So doing some of these things and getting this stuff better from the buyer's perspective, you can flip the odds. I mean, we don't live in our business with 25% odds. We're in the high 90s. We strive to sell every one of them, but you got to do work ahead of it to do it. And we're continually proven wrong if we skip the steps that you need to do to do it. It doesn't happen without making sure that your business is ready for the sale. So first thing you need to understand is what's the value of my business today, and really get comfortable with that value, because value is not an arbitrary thing that someone can just like, oh, it's worth $100 to me or $1 million to me. This math, it's simple math. It's like you have a business that's generating $300,000 a year in cash flow that the owner can do whatever they want with. They can use it for growth. They can use it for, themselves for income. They can do whatever they want with that $300,000. And that's awesome for you. The one of the things that's going to happen when the business buyer comes in is they're going to have to take that same $300,000 and they're going to have to pay back the loan or the investment to buy the business. They're going to have to pay for growth, and then they're going to have to pay themselves. And these are the kind of things that this is struggle. And so this is math. So your 300,000 as a business owner that's been in that business for 20 years, and you don't have much debt, you're not paying the business back, your lines of credit are really fluctuating like they should be if you're using them, and you might have some equipment debt, but you don't have the debt from buying all your equipment and everything. This is a big chunk of money that they're going to plop down in your business, whether it's 500,000 or 5 million. It's a big chunk of money to them, right? And they have to balance that. That's value. That's value. And if they're going to the banks for an SBA loan, the SBA banks and under $5 million, if you can sell your business to somebody that's using an SBA loan, you as a seller get more money at the close of the sale, and it's much better for the buyer too. But the banks have lending requirements. They're going to say that the business has to generate enough cash flow to be 1.5 times the payment. But so your cash flow that they check it against is just like I said, my cash flow, monthly cash flow, minus my growth capital, minus any other kind of investment I need to make in the business. They roll that all together. And then they make sure that's enough to cover the loan payment. And that's how they do it. And they do it over a 10-year amortized loan. And it's a good deal for the buyers. It's a good deal for the sellers. And it's one of their better programs. Most of the small businesses get sold like that, but understanding your business value, it's math. It's math. That's the long and short of it. And the average on a smaller business is about 2.5 times the cash flow. So if you're making a few $100,000, your business is going to sell for, what's that, $650,000, $700,000, something like that. That's what it's going to do. So let's see, that's my notes on that one. So when we talk about next thing. And we talk about the chances of selling. Once you know the value, then it's like, okay, I have to make my business sellable, because the value of your business is completely independent of it being sellable. There's one thing a lot of people do is they'll get a business valuation and say, oh, my business is worth $5 million. I should be able to sell it for that. It doesn't work like that. Your business can be worth $5 million, but if you look in the fine print of evaluation, it says this is the value we think it is between a willing seller and buyer. That's a pretty big statement. So you got to make sure that your business is going to find this willing buyer, and really start to look at the business from the buyer's perspective. Like I said, value is first thing. Get realistic with your value. And if they're coming in close to the value, that's good. But then you got to look through the different things. And how does my business look from the outside? New buyers are going to look at things that you may or may not look at. They're going to look at your Google reviews. They're going to look at things if you're got something on Glassdoor. They're going to look at all that. They're going to search digitally until they can't find anymore. They might talk to others in the industry about your business and get this thing. Good question. I'll stop for a minute there, Dave. Cash flow and sales are not the same thing. Not 2.5 times the income. It's times, and I'm not a great financial person. A lot of times it's the net income, but your revenue, it's usually about 0.5 to 0.75 times your top line sales.
Damon, real quick, and this is, I really feel strongly about this, and I think you'll agree. That's why I really like the profit first process that we teach at the Green Executive. And there's some clients on here that are profit first customers, is that we look at ourselves as cash flow architects. So literally what we do is we help with paying down debt. We help with getting a positive cash flow, and things that you have to take into consideration of is, your P&L might look okay, but if you have a lot of debt and things that are living on your balance sheet, that negatively affects truly what your profit is on a cash basis.
Yep.
So if you're not doing profit first, you're, in my opinion, you're really not setting yourself up for some success with having positive cash flow, not positive profit, but positive cash flow.
Yes.
And that's why
I'm glad you said that. I'm glad you said that, because that is what they're trying to figure out, and they will subtract for debt and things like that on your cash flow. But the thing that happens, and this is for you as a seller of a business, you want to get that debt paid down, because, and I was going to talk about on a future slide, but when you sell your business, you have to pay all the debt off, or you have to negotiate them to take over the debt, which most of the time it's hard to do just because of the contracts on the debt or equipment, all that other kind of stuff. Usually 99% of the time it's just paid off, and you get to pay that off. And we'll talk about that a little bit more, but that is the cash flow, Adam. I'm glad you mentioned that. So the second thing is, once you understand the buyer's perspective, and we're going to talk about risk and some of those things but really you got to put yourself in that buyer's shoes, look at your business, and then you want to, and really understand what they're walking into. And then you look at owner dependency. How much is it dependent on you? How much can you take a couple weeks vacation? Can you, you got to be able to break free of the business, and they still get work coming in and get work executed. That's the biggest part of it that you need to do to break your the owner dependency, because the new buyer wants to see that you're not critical to making the business work. You're going to give that leadership. You're going to, there's big decisions you're going to have to make, but on the day-to-day, if you're not making the trains run on time, that's where you really want to be, because it's going to make a huge difference for the buyers, because then they don't have to have as much knowledge about your business, about the industry, that it's going to make or break them. They're looking at risk. They're spending a lot of money, and you got to always keep that in the back of your mind. So again, we're talking about reducing business risks, and we talk about these risk builds up over time as you own a business. Over 20 years of running your business or decades of running your business, you might have a customer that has been there from day one. And they might start out as they were our customer from the beginning, and they may be 70, 80, 90% of your business. You know their kids, you've been around them for a long time, and they've really been good customers to you. If you've got too much business tied up in one customer, that's a huge risk for a buyer. They don't have that relationship that's built up over time, that has the road miles that you have with that. They're going to look at that and they're going to say, well, what if that customer walked away? What happened? So the biggest thing that we see in that will just cause people to walk away from the sale of the business is if you got more than 50% of your revenue with one customer, it's going to be tough. You want to try to diversify that by adding other customers if you can. Or if you can't, some agreements and other things like that that can help you, bridge the gap for that new buyer would be very, very important. And the second thing that buyers look at much differently than you do, and that is your team. Your team is critical to selling your business, because you can run a business if you're really good at your business. You can keep everything juggle, keep things going, and you can have a lot of people just doing the things that you need them to do. But that's not building a valuable business like you can, if you've got a team that actually can execute what you want to do on a daily basis, and you're just helping them make sure they've got the tools they need, and you've laid out the long-term plans, and you're actually a leader rather than a manager and an executor. And that people part of it is one of the things that's really important. And it's also important that you have people that have good experience with years left in their career. We help manufacturing businesses, and that's a problem in some of our manufacturing businesses, because when they walk in and they see a whole bunch of people that look like me, they go, oh my goodness, how many more years are they going to be in here running, CNC machines or whatever the heck they're doing? It's a big deal. So spending more time and more attention on your team as you get near your exit's a big deal. Last but not least, I always love to talk about this with equipment-based businesses. Don't fall in love with buying new equipment. Don't fall in love with buying new equipment. And it's like we said before, you have to pay this debt off in the end. Good, well-maintained equipment in that nice piece of the life cycle where it's got a lot of good life yet, but I'm past that initial part of it. Do that. And, it might look nice that you've got the nicest set of vehicles out there in the world, but if you have good vehicles that look decent and you keep them clean and they're badged up right, that really nice, everything less than 12 months old, kind of mentality on your vehicles and equipment, it's only going to cost you more at the exit, because you have to pay all the debt off on that when you sell the business anyway, or they're going to discount that. Go ahead.
Damon, I always coach my clients to ask themselves these 3 questions before they make a purchase. And the 3 questions are, is the purchase when I'm about to make good for the company? Is the purchase when I'm about to make good for my customers? And the last question I have them ask themselves is, can the purchase wait?
Yeah.
So that's kind of like the sniff test, because especially landscape contractors, they love that shiny new equipment. And you know what? If it's something that that you're in this business for the long term, and you have a plan in place that how you're going to literally try to keep this truck for 10 years.
Yeah.
Okay. Right. And make sure this piece of equipment that you're going to purchase is something that isn't going to sit at the shop 2 days a week and only be worked 3 days a week.
Yep.
So just, you got to be smart and somewhat frugal with your money. And you don't want to have, like you said, all that debt out there, because somebody's got to pay it off, whether it be yourself or when you come time to sell, it's going to devalue your business some, because someone's take care of that.
It's just going to take cash at the sale. And we really encourage what we call red zone thinking. You know, I'm a football fan. When you're inside the 20, you play a lot different. And this is with a business sale too. If you're in the last few years of running your business, you get even more critical on these decisions. You go, hey, does this really have 5 good years on it? Because that'll go a couple years into the next owner and I'm good. I don't replace that kind of thing. And it really makes a big difference. So I'm glad you brought that up. Awesome. Awesome. So then this is one that a lot of people, if we're talking to a business broker, they might not bring this up, but the value of your business is adjusted slightly up if you have good growth. I mean, we've seen as high as a 25% increase in value if you've got really solid growth. And you can show that, listen, I'm in the middle of a growth curve here, and I've got these things that are ready to hit, and I've got, you know, these that are already starting. That's a big deal. You can adjust it. A reason I want to talk about business growth is because the buyer's perspective on this. They're looking at the cash flow today and they're saying, can I pay this back? Am I comfortable with paying this much money today if something happens? Right? They look at, oh, if we drop the biggest customer, what would that do? Well, if I got a good growth curve going, if I'm growing 15, 20% a year and I drop a fairly sizable customer, that'll cover it maybe. And this really helps to show them that, listen, you're reducing the risk because, listen, even if we have a hiccup or something else, we've got new things that are happening and growth is going on. And that will help to make this better. This is really one of those things that as you get into your business for decades, it's hard to go, okay, we got to keep growing, because you're like, I'm making good money, I'm where I'm at. But this buyer's perspective, they're really looking at it from a different viewpoint. And if they don't see that value in it, it's going to be hard, that growth in it, it's going to be harder for them to get by some of these risks, because growth covers up problems. It doesn't cover up problems, but it helps them to deal with future problems. So, and that's really, really what it is. And when we talk about growth, it's like, if you're talking to a buyer about, oh, I could go off and do this and then go off and do that, that's not going to get you more money for your business. What's going to get you more money for the business is, I've signed this contract that starts 6 months from now or a month from now, whatever it is. I'm in conversations with these 3 other ones that we really think is going to be good. And here you can see that this is going on, and you can see we've demonstrated the growth in the past. And what I like to call it is partially realized growth. Everybody's got blue sky, but buyers will pay 0 for blue sky. They'll listen to it and they'll nod their head and won't pay a penny for it. If you can show that you've got growth, and I've got some other things that are plopping on top of that, and I've got these other ones that we're actively engaged with, and it's going to come, we think at least a few of these are going to come to fruition and continue that growth, that is where you're going to really get the full benefit from growing your business. Flatline businesses are hard to sell. Doesn't matter if they make millions of dollars a year, a flatline business is hard to sell. It's way harder to sell. And especially if they're smaller, or it makes it harder. If your business is declining in sales, don't even try to start selling it. It is such a pain. I mean, and we'll talk about this in a minute, but if your business is not growing at all and it's declining, bite the bullet and don't try it. Because there's other options that you probably want to do until you either get into a growth phase or you decide a different way to exit. So those are the main things that I was going to talk about, the kind of things that you want to cover to make your business saleable. And the last thing I really wanted to cover was ways to sell your business. And this is something that you can affect a tremendous amount. And that is, you always think about, oh, I'm going to use a broker, or I'm going to list it and sell it myself, blah, blah, blah. There's really a few ways you can do it. You can sell to a competitor. And when I talk about this is one of the things that we've really seen in the last couple of years that's gotten more and more attractive for buyers and sellers in the industry. If you're getting ready to sell your business, I'm going to be doing it in 5 years. Knowing the 10 other competitors that are 20 years younger than you, that you really respect in the industry around you, that's your best place to look to sell.
Take them to lunch.
Take them to lunch. Exactly. Take them to lunch. Get them to understand what kind of businesses, understand what kind of business they run, understand what kind of business you run. If you really like that person, start talking to them about it early, and really go whatever you got to do, because you can sell your business like that. You don't have to go to an outside source, and it's tremendously easier if you can have those conversations 5 years ahead of the transaction and say, listen, in 2020, whatever, I want to sell my business. Today, I've been looking at values, or I had a valuation done, and it's worth this much, and if we keep growing, it'll be worth about that much, blah, blah, blah. And really having these conversations early with someone that you respect in the industry around you, that is such a great way to do it, because you take out one of the hardest things in selling a business, and that is finding the right buyer. And if you do it over time, you can find these people and build good relationships with them. And then at the end of selling your business, it's so much easier, so much easier. And the other thing, when you look at the cost to sell a business, to have a broker sell your business, it's going to be about 10%. Might be 8 to 10%, might be even higher, might 11 or 12 even on the high end. And that's, so if you got $1 million business, that's $100,000. Well, and then you have legal costs, because the legal costs are going to be, might spend $5,000 in legal costs. You have a little bit of closing costs, another, $1,500, a couple thousand at that most. So if you can take another $100,000 and put it in your pocket, because you've spent the time over the years to find somebody that you go, okay, I'm selling it to Adam when I'm done, and Adam knows he's going to pay about this much money. And we've already, I've gone to the bank, because that's the other thing you can do as a seller. Go to an SBA lender and go, hey, is my business worth lending on? And if they're and they'll tell you how much they'll lend on it. Get this stuff prepared and do this kind of stuff, because it's one of these things that you can do yourself if you really want to do it, because it'll save you a lot of money. And when you're looking at that money out the door, that extra whatever could really make the difference. So that's the first thing, is you sell it to a competitor, but doing it a little differently, because you can take a lot more money home. And B, the other thing, which I like this, I can't remember if I said this at the beginning, but I grew up on a large family farm in South Dakota. So I'm not your typical investment banker, business broker person. I went to school for engineering, and I worked my way up and had to learn this stuff as I was doing it for people. But we were able to, when my family decided not to farm, we were able to help someone that we really respected in the community take over our family farm. And when you can do that, the legacy you can leave by knowing that, hey, Steve was a great person in my community, running a good business, treating people right. He's going to take my business and it's going to go on well with him. That legacy part of it is really cool, because a business broker, they're going to sell to the buyer that's got the money and willing to do it and ready to do it. And in that case, you might make a decision that you not necessarily would not like that buyer, but you can certainly be a lot more choosy if you do it this way over time. And last but not least, you can sell to your employees, but that is something that does have an inherent risk in it. If you are not going to be able to get a loan and somehow do that, and you're going to sell over time with a seller note, there's things you can do that if you really think they can do it, but make sure your lawyer is helping you on that part of it. So, and we said this is going to be 30 to 45 minutes. We got times for questions, but in the end, if you put some of these things together, you can exit the way you want, and you can get the money out of your business you're going to need. It just takes some time and some effort to do it, and intentional work. So thank you. Thank you.
Thank you, Damon. Awesome presentation. I loved it.
Yeah, so I'll stop sharing and we can answer any questions. I see Bryson asked, why not subcontract? What was that? Subcontract what?
The actual sale, or you talk about your subcontract out your work to subcontractors. Bryson, are you still on? And could you clarify?
Yeah, she's
Instead of selling your business, he says, why not? Oh, just basically subcontract out the work, I guess.
Oh yeah, you can do that. That's a way to do it. Yeah. But the only thing about it is, if you're going to do that, if you're subcontracting out the work, you really are still at risk for that work.
You are, yeah.
And that's the thing that you really, and this is contracting your work goes back to one of the very first thing I was talking about, is you can run this business a long time and then close it down or do whatever you want as you feel like it. And that's a great way to do it. If you're like, hey, I want to still be making some of the money, but I don't want to handle the crews and everything else like that, it's definitely a way you can do it.
Damon, how important is it, part of our profit first process that we teach is that the owner gets paid instantly. How important is that to a potential buyer, that they can see that the owner is also, pulling a fair paycheck out of the business?
It's critical. I mean, they're gonna look at it and they're gonna go, it happens all the time. It happens all the time when we look at businesses, that they go, well, the owner not pulling a lot of money out. Maybe everybody else is getting paid and they're getting paid nothing. Mm-hmm. It could be they have other things that are generating income. They really don't need it. But again, from the buyer's perspective, I'm going to pay all this money and I'm going to get a little bit of return.
Sure.
It's not enough return for them.
And if the business can show the potential buyer, I assume that the business can run without them being there. I think you touched on that a little bit. That's definitely helpful. Or the owner can go on a 2-week vacation.
Yep.
Owner dependent. I know stuff like that is people don't think about, but if you could literally show that, that, hey, look, here's my itinerary. I went on vacation last week for 2 weeks. I mean, that's just, all that stuff helps out a little bit, right? So
it helps out a ton. The owner dependency is huge. I mean, there's 3 things that stop people in their tracks. They won't even look at your business any farther. First of all, if you're not realistic with the value. Second of all, if you've got too much customer or owner dependency. Those 3 things will just boom, boom. They won't even say why they don't want to look at it. No, I'm not interested.
Sure.
So it's huge. It's huge.
I asked everybody to unmute if they have questions. So I'm going to go ahead and allow anybody that has individual questions to go ahead and unmute themselves and ask away.
All right. Well, I will ask. The other thing I will say is, if people want to talk to me, reach out to me. I'm on LinkedIn. You can find me there, and add them the details. But we can talk about private things that you want to talk about as well. I mean, because a lot of times there are things that come up in this that are both hard for you to get over. I mean, really, selling a business is an emotional thing. You put your life into these things. You've sometimes you've given up vacations. Sometimes there's a lot of times in the beginning that it's really hard, and it's an emotional decision. It's a life-changing decision. But I tell you, when you do it right, the satisfaction that comes from selling that business or seeing that you built something. And that's why I really like the idea of finding somebody that's younger and that would be interested in buying your business rather than selling on the market. And I sell business. Our company sells business, right? I just think that if you can develop that relationship early and you can do it that way with someone, you're helping them with a leg up, and you're creating a great legacy for your business. I just think it's such a win-win that I encourage people to do it all the time.
Love it. If we could just hang tight for maybe 30 more seconds. I know sometimes it takes a little bit of time for those questions to come in by the time people
Yep.
unmute everything. But any questions at all? Like I said, feel free to go ahead and ask.
So I guess I've got one, but and Adam will see it when he arrives. But I've generally had newer equipment. In the past, I wasn't so much. I was holding on to trucks for a long time, and basically my tax accountant advised me to stop doing that because those trucks have no tax benefits at all, and it's hurting me. And so I'm using trucks for depreciation and tax incentives. And they're obviously more reliable and dependent. You don't have to worry about it. Maintenance cost is down, a lot lower. But I don't know, I guess what's your thoughts on new versus old equipment? I know it's expensive, and if it's not paid for, you'd have to pay for it, but
Yeah. I mean, that's the biggest thing is you've got to pay for it when you sell your business, because you have to pay the debt off. And, you really, and that comes from the proceeds, right? So if you're going to get paid $1 million, that debt comes off first. And really, or do you want to, over the next few years, what's your maintenance cost over a few years compared to the debt you're going to have to pay off? And that's really one of the, are you going to make more money paying the debt off and not paying the maintenance? Or are you going to make more money by paying the maintenance, keeping a little older equipment, and not having the debt to pay off at the end?
yeah, and possibly having to hire a full-time maintenance guy to keep up with it all.
Yep. That all adds in.
And I think there's a fine line between keeping something that's really old and
Yep.
and always buying new equipment too. So, I mean, I think you could easily get, out of pickup trucks. There should be no reason why you can't get 6, 8, maybe even 10 years out of pickup trucks, depending on how many miles you put on them. And I know, for at least for my company, dump trucks, I mean, they put very low miles on dump trucks. So keep that in mind. And then, also, I think it's also important to always consult with a good CPA, and they may be able to help you there as well, because you don't necessarily need equipment to offset your profits. We're doing some things in our businesses, such as, reducing your income by doing things like simple IRAs in our business, to ourselves as key shareholders and things like that. Once again, I want to stress, always consult with a CPA on that, but you can find other creative ways to have deductions out of your business, or write-offs, whatever, however you look at that, versus always necessarily buying equipment that you may not need.
Yeah. And I don't know if you were on there, Dave, when we were talking about the red zone thinking. This obviously changes a lot in the last 3 to 5 years before you sell.
Yeah.
So
At least at this point, I would be able to pay off everything before then. I don't plan on retiring for, I don't know, 15 years.
Yeah.
But
Yeah. So it's good. That's a great question. Because you can rack up a lot. I mean, equipment financing people love to finance you.
yeah, and we do still have a lot of old stuff. We use a 2005 Dodge. It's literally been paid off for 12 years.
Yeah.
But,
Yeah.
Any other questions? Going once? Going twice? All right.
thank you, guys.
Thanks again, Damon. I really appreciate it. This was recorded. It is going to be uploaded to our YouTube channel, and I'll share it out as well. So thank you, everybody, for joining today. And once again, Damon, very informative and helpful, and I appreciate your time.
Thanks for having me, Adam. Thanks, everyone.
Take care, guys.
Thank you.
Bye-bye.